Good afternoon. My name is David Auerbach. I'm the Chief Investment Officer of Hoya Capital, and I'm excited to be joined by some old industry friends and clients from way back in the day who actually head up research at Green Street Canada. Fred Blondeau and Gaurav Mathur. Great to see you guys. And I said to Fred earlier, in case you didn't know, I'm actually sporting my old Green Street sweatshirt today in honor of our conversation. So I figured, got to pay the respect and obviously, I love this sweatshirt, especially on a day like today where it's single digits here in Dallas, Texas, of all places. It's very appropriate. So we're going to go through a big macro to micro presentation as an overview of Canada REITs. The goal here is to educate, frankly, what's going on up north. And guys, one of the things I'd like to kind of set up in advance is as we're talking about this, since everybody's so, let's say, U.S. focused, maybe you can highlight some of the contrasting differences between Canada and US as we go through some of this stuff. Um, Ideally, the goal is for the audience to understand some of the Canadian REITs that are up there, how Green Street Canada does their research process, and more importantly, what could be ahead for Canadian REITs in 2026. So we have a little presentation here up on the screen, and the first slide obviously goes over Fred and Gaurav's bios. I've known Gaurav back to his BMO days. I know Fred going back to the Prosima days, but they have spent pretty much their entire career up north and are used to a nice winter ice storm year to year, unlike most of the country that's going through it right now. So let's start out with a big macro focus here. You guys have this slide about GDP and employment growth. I'll let you guys take it from here, and I'll sit back and we'll kind of go from there.
Thank you, David, and it's a pleasure to be here with you today, notwithstanding what's happening outside, both here in Canada, but more importantly, in Texas. And got Gaurav who will also comment on these slides. The first, look, what we wanted to say is when you compare the Canadian economy with the US, I'm sure you heard that numerous times. Here, things are not super exciting for two reasons, really. We don't have a strong job market here, and inflationary pressures remain very present. So what does that mean is that puts the Bank of Canada kind of in a tough spot, right? So I think me personally, and I'm not an economist, we don't do anything internally, by the way. That's all Oxford, but our opinions, of course, are ours. And I think that the Bank of Canada will keep the dry powder for a little while. So what that means, when you look at the 10-year, the 10-year is it remains quite sticky around 3.4, 3.5%. And you got the USMCA agreement that's coming due in July. So that's a big thing for us. So you heard President Trump mentioning that basically he doesn't care about the USMCA. I think he's absolutely right saying that, but for us, it means a lot. And I think that might create some uncertainty. So that's one of the reasons why I think at the Bank of Canada, they might keep the dry powder for a little while. The housing market is a bit in disarray here, especially in Ontario and in BC. You also have maybe not everybody knows that, but we have some political friction at the provincial level, both in Quebec, province of Quebec, and in Alberta at the moment. So that's real. That's real concerns, real movements, pressures. So that could add some volatility here. Call it over the next 6 to 12 months. So again, in the meantime, I don't feel like the Bank of Canada has much of a choice to remain a bit cautious here. So if you flip on the second page, David, and Gaurav, please feel free to jump in if you have anything more to add. Population growth here in Canada has been a big subject since the end of 24, right before the 25 elections at the federal level. And that created a bit of uncertainty for certain real estate sectors, notably the apartment sector. Keep in mind a few things. The first thing is the rest of the country's population is decreasing. It was probably decreasing in 25. It will decrease very likely in 26. But as you can see on the left chart, we're well above pre-pandemic levels. So that's the first thing. The second thing, Alberta population is still growing. That is despite losing non-permanent residents, Why is that? Because cost of living is just more affordable over there. And I personally feel that there is a sentiment that if the province do secede, that could create some positive movement, positive sentiment towards the province. Affordability is a big thing, and the rest of the country is being impacted by immigration. So especially in Ontario and BC, people are leaving. They're just leaving in record numbers, and that's all relating to affordability and lack of jobs, maybe. So if you flip on the third page, David. Now, when we look at the unemployment, I mean the picture was already pretty bad over the last 5 years, from 19 to 24, with a national growth of less than 2%. And it looks like going forward, things won't improve anytime soon. That's Oxford, right? So that's less than 1% job growth for the upcoming 5 years. So I mean that's a major factor here impacting the economy. And what you're saying on the right side, David, is that over the last 40 years or so, I mean, there hasn't been there's been a secular lack of investment, and that impacted productivity in the country, and that's a problem that is secular and that's not going away anytime soon. So that's going to impact. When you look at international fund flows, I mean that's one also a factor impacting investors' psyche about the country. So perfect. So when you look a little bit deeper in terms of the job growth, I mean, of course, office using employment is growing faster, but there's nothing too exciting there either. And what you see on the right side, David, is that since the end of the pandemic, I mean, office jobs have been decreasing really in terms of job growth. And going back to the left side, what you can see here is, generally speaking, the province of Quebec is relatively slow. And if you later we'll talk about our expected IRRs, but we tend to stay away from the province of Quebec. Generally speaking, Montreal and Quebec City, they're markets that are a bit lackluster at many levels. And what you can see also on the left chart is that Edmonton and Calgary in Alberta are projecting very well compared to the rest of the country, along with Halifax, and a little bit less so for Toronto. Now, the big question, and we started hearing about tariffs last year, is how are we doing versus our partner in the US? And what you can see on both sides, on the left side and the right side, is that that volatility kicked in terms of our activity with the US last year, and doesn't seem like it's going away. But if you look at generally speaking, on the right side, the U.S. represented about 75% of our total exports. That's a big thing, of course. That's a big factor for us, and it touched the 70% a few times since last year, and you can see that the trend, it's pretty negative, and so we'll see for the upcoming quarters, but it looks like volatility is not going away in that regard, and so will be, I think, economic growth here in Canada. Now, the next 5 slides relate to the consumer over here, and you'll see on the fifth one that the consumer is pretty stable, notwithstanding those numbers. But what you can see here, and we heard that several times over the last few years, that the household here are much in debt, And you can see here the debt service ratio of 14.4% at today, and that increased quite a bit over the last over the last 20 years or so. On the right side, you can see the impact of I was mentioning the 10-year. I mean, interest rates here have increased quite a bit over the last 2 years, and that's impacting households directly on their refinancings here. Most financings were done on a 5-year basis, and a lot of them came due over the last 2 years. About 50% of them came due over the last 2 years, and that's impacting households' ability to consume here in the country. Now, if you flip on the next page, you will see that that's impacting also the home sales activity. So I mean, and the same for the condo market here is in pretty bad shape, especially in Ontario and in BC. And the home sale activity is expected to rebound next year, but that's not our numbers. Of course, we don't do any forecast in that regard. But I would tend to be a little cautious on that rebound that you're seeing on the left side here for Canada. You see, like, we were negative last year. Most likely, we don't have the final number yet. But for 26, I mean, we expect that big rebound. I don't know, Gaurav, do you have any? Like, I have doubts about that kind of rebound.
Yeah, I mean, it's still a market that is characterized by a lot of debt, and the fact that, while we think consumers are stable, they're still spending on debt. And just as a reminder, when we model out our forecasts across different sectors, we use, I'd like to say, about 120 factor model that goes in. But one thing when we talk about Canada is, okay, immigration, yes, that's quite the tailwind, but that's coming in. The other thing is job growth, and when you're not producing jobs as an economy, and you're not able to push wages up, then that does have a cascading effect on not only on what you're spending, but your rents, home pricing, all of it. And I think around the pandemic, we did see home prices shoot up because rates were ultra low. But now that they're coming back to normalcy, we're starting to see that pull back in the housing market, and something that we call for as well. And yeah, it wouldn't be too far-fetched to say that there's still some more of that to come.
The other thing I would mention, David, if I may jump in here, this situation here with the residential home market might impact demand for senior housing. Now, it's very well known here that hasn't been any new supply of senior housing for the longest time, and demand is to the roof. So don't get me wrong. I mean, on the demand side, our population growing older, and it's like compared to the other cohorts, I mean, it's rising very fast. And but I would have to imagine that such conditions might impair demand a little bit going forward. Now we'll see. I mean, so we're thinking about 3 to 3.5% rent increase, still very healthy compared to other sectors here in Canada. That's our favorite sector from a fundamental standpoint. But I would have to say this situation here adds a little bit to the risk profile of senior living at the moment. If you flip on the next page, the one thing that we want to show here is that, yes, we were at record lows in 22 in terms of mortgage delinquencies. But not sure if you can see, but on the right side of this chart, you can see that Toronto, the dark gray line, was very low, 3Q, like third quarter of 22, and now it's getting above the national average. So this is a reflection of some pressure in the market and some pressures on I believe on the consumer at the moment. And that's not going away either. I think the situation did deteriorate at the start of the year, and that's also a situation that we'll continue to follow very, very closely. Now, all in all, what impact does this all have on the sentiment? Sentiment is pretty bad. So across the board, both from a labor perspective and a financial health perspective, the consumer is very cautious, and it's been like consumers have been cautious for a while now, almost 4 years, and it doesn't seem like the situation is improving anytime soon. Now, if you flip on the next page, David, you will also see that despite this, the consumer being cautious. I mean, if you look at the sales per se, they've been relatively okay, very stable. Now, of course, since summer last year, you can see that it did correct, and we'll see where does that leave us. But when you look versus the 24-month moving average, I mean, look, I mean, it's pretty stable despite this. When you look at the index, you're like, okay, things will fall off a cliff. That's not happening yet. So strong resiliency from the consumer here in Canada, David. So that pretty much put an end to the general context of the macro. Happy to jump on the sectors here.
You threw a lot at us. You threw a lot at us starting out here. A lot of great color. I've heard about softness in the condo market up there through one of our mutual associates that we know, and we know a lot of those folks are feeling the pain. I will tell you, you mentioned senior housing as well. I did an event last week with Hazelview, and one of their top picks this year is Chartwell. They love Chartwell, and I know that's a company that you guys cover, so I'm sure we could talk about that. But besides senior housing, a lot of the other stories that you mentioned seem like there was a lot of headwinds that a lot of these sectors are facing. And so I'm curious, I know we're going to get down to the micro level here, but I guess maybe more on a sector basis, are there other sectors that are really performing well to the tune of what senior housing is doing? Or is every single sector in a challenge situation right now for their own set of reasons?
So the one thing I will mention, David, I'm sure Gaurav will have comments on that. Keep in mind that from our perspective, sector picks is the most important thing, because this is where you add the most alpha compared to the actual market picks. So we put a great focus on that. And nothing is exciting here in Canada, exception made of senior housing. So when you look at the four traditional sectors that we formerly cover on the private side here, we tend to stay away from apartments and office, generally speaking. And the two sectors that we feel like will outperform here very closely is strip centers and industrial. But that doesn't mean that we're super excited by strip centers and industrial. That just means that from relatively speaking, these two sectors will outperform. And keep in mind that for most of these four sectors, exception made of office, there's been a ton exception made of office and retail. I mean, industrial and apartments, there's been a ton of new supply over the last, call it, from during the pandemic up until very recently, and that's still impacting those two sectors. But nevertheless, looks like industrial and the strip centers could outperform here. Does that answer your question, David? Yeah, and one sector that we added, we don't cover it formally on the private side, but that's one sector we cover on the listed side, just like senior housing, is self-storage. And I would say self-storage is our second favorite sector here. That's one sector that is doing exceptionally well. The only thing that we mentioned at the high level on self-storage, that there's been some prominent trades here in Canada, but from U.S. investors and from pension investors. And so with relatively or arguably lower cost of capital here, so that did have an impact on overall valuation levels here. So that's kind of a that's adding a bit of cautiousness, but nevertheless, fundamentally, self-storage will do very, very well compared to these four sectors that we just mentioned.
Anything I can add?
And I think Fred summed it up very well. I'd just bring out one thing where I said when we look at the four traditional asset classes, they are working or they are sort of providing a return profile that's quite similar to each other. It's you're not seeing a lot of divergence there, and they all four seem to be trading in a very similar band. Now, that said, there are opportunities in the market. And again, where you're going in with your yield, what's your capex burden on those assets? What sort of an NOI growth profile are you underwriting? That does play a huge difference when you're looking at certain sectors. But from our conversations with our clients, the question then is there something really out there which makes sense to do? And we have seen opportunities come up in the past year that have made a lot of sense, and we expect there'll be more things shaking loose, and there'll be some appetite from investors going forward.
What's your thoughts about, let's say, market saturation? What I'm getting at is back in the day when I was on the Green Street desk, we used to joke that all you need to own was Rio Canyon Boardwalk and you've got Canada covered. And here we are many years later, and if I'm looking at the sheet correctly, you guys cover 15, 15,
16,
20 names up there now.
16.
Like how big is that universe evolved? And like, thinking about domestic, it wasn't until the past several years that like tower REITs came into focus, data center, cannabis, billboards, some of these other niche type sectors that are out there. What about like in Canada? Is there demand and opportunity for some of these other unique sectors that kind of what we see here in the States?
Yeah, maybe I can start real quick, David. From an international standpoint, 20 years ago, Canada was about 5%, well, not even 4% of the global index. Now it's less than 2%, maybe 1.5%. So there has been consolidation, there has been privatizations, and there has been, a bit of underperformance more recently versus the global market. So I would tell you, the Canadian REIT sector is quite small, and it doesn't like, just to give you an idea, last year the biggest ever REIT IPO in Canada was done in the US, right? So with Go Residential, and so that kind of gives you an idea of where we're heading here in Canada. I mean, there's not much happening on capital market side. There's been a ton happening on the advisory side here in Canada, but to say capital markets, the appetite out there is relatively it's pretty slow. And keep in mind also, David, a very important thing in the US, 75 to 80% of the market cap for the listed real estate is owned by institutions, right? And the rest is retail. Is the other way around here in Canada, right? So it's 80% retail market here. So that's why, the banks, whenever they want to raise capital for these REITs, I mean, they can do it because their retail systems are so big, right? So they have the capacity to raise that capital for REITs here, but that's only if the REITs is sold 50% plus to retail investors. So that's also a big factor when you compare, Canada versus the rest of the world.
Besides Green Street's relationship with institutional investors and, doing the Green Street thing, what else is it going to take for more institutional ownership of the Canadian REITs?
Gaurav, you want to?
Sure, I'd say top of mind, better disclosure levels would be a first. Again, most institutional investors are extremely smart. They're looking at what's happening in the States. They're looking at the level of disclosure there, trying to make comparisons here. It does get a bit iffy, especially when, the disclosure levels are not up to the same standard. Two, in terms for liquidity to come back into the market, we think that, there still has to be a bit of price discovery that's yet to happen. And until that does, it's not really going to, you won't really find a lot of institutions sort of backing up the truck here to allocate capital to Canada, whether that's from a REIT perspective, whether that's from a private market perspective. And just as Fred mentioned earlier, like 20 years ago, probably 2004, you know, REITs were about a $20 billion market. Now they're probably closer to 70. So it has grown. There are a lot of opportunities here. But there's a lot more that needs to be done. And I think the third thing that does come to mind when we're comparing REITs globally is leverage profiles. A lot of investors have to wrap their heads around why leverage is much higher for a Canadian rate versus that in the US, and where's the growth really coming from? So still a bit of ways to go, but again, there are plenty of opportunities. We've seen just last year we've seen a GIC come in and buy out an interrent, for example, right? So there will be certain platforms out there that do make sense for a discerning investor. And I think one of the questions that we got on that transaction was, would there ever be a counter bid? And I said, and I think from our analysis, what came out was the answer was no, because we realized that, this is being bought by a sovereign wealth fund, which is looking at it over a 50-year horizon. The difference is a lot of institutions might be looking at certain investments over a 10-year horizon, and a lot of these REITs or private market portfolios may not just fit that bill just yet.
And David, if I may add here, there's a difference to be made between private and listed markets here in Canada, and I think Gaurav
I
brought
want
it
to
very
pull up
good
that.
point.
I want to pull up that slide as you're talking about that, please,
Sure.
because you had this really good slide talking about private, and I wanted to kind of get into this.
Yeah. So here you have an overview of what we cover on the private side, and where I was heading with this, David, is that I think Gaurav brought a very good point. When you look at foreign investors have been very, very cautious about Canada over the last 3 years or so. But for the right transactions and for the right platforms like InterRent, like Amica, and we saw this morning Deca Bank investing 300 million here in Montreal, buying office, a high quality office building. Like, look, I mean, if you look at Deca Bank is based in Germany, of course. If you look at how the Canadian dollar has been trading against the euro, I mean, it's an all-time low now. So that's a very good timing to come in Canada for the right product, right platform. You're going to see a bit of that. But when you look at the overall institutional market here in Canada, I mean, you got about 50, well, okay, maybe I'm a bit too aggressive here, but call it 40 to 50% of all the funds that are gated at institutional managers. That's not going to help the profile of the country for call at least 12 to 18 months. So that's another factor, David. I think that it needs to be mentioned. Things will be relatively slow at these portfolio manager funds, and I think that, but I also think that for the right platform, might see a bit more consolidation here in the country. Now, to your previous question, David, about the non-traditional asset classes, yes, we do get a ton of questions on how our clients and institutional investor can diversify away from the traditional asset classes because they don't get those returns. And so they're asking us about data centers and self-storage here in Canada, but we keep telling them that, look, I mean, data centers will be very, very tough, at least for now, because there's no ability to scale that sector at the moment. And so we're starting to see a little bit more activity in the self-storage space. But even that, I mean, there's been a bit more construction, but for institutional quality products, is still very minimal here in Canada. So back to Gaurav's point, I mean, we need more scale, capability, and liquidity as well.
So before we go into the table, looking at your universe, you mentioned the Go residential deal that occurred late last year. Also, we saw Smart Stop from your neck of the woods listing here in the States. BSR, obviously also up by you, that's investing here in the States, and I know we really can't comment on that, but wouldn't be shocked if that's in play in some form or fashion based off of previous conversations with Avalon and some of the other guys that are out there. So it's interesting to see some of the Canadian guys, listing, dual listing, owning here in the States, but they're up north. And I feel like that's something else we might be seeing more of because I thought the Go deal was kind of interesting for, frankly, a small asset base to go out to shoot with. Um, but this is really interesting looking at your coverage table here. I see Chartwell, you got a hold. So Sam, if you're watching this, Green Street's got a hold on Chartwell. Um, but I'd love to, frankly, for somebody who may not be familiar with some of these companies, and we can talk about the buy, sell, hold recommendations. I don't want to necessarily focus on the buy, sell, hold side of it, but more on the story angle, how it fits in the broader landscape, maybe differentiation from some of the peers, et cetera. Like, again, this is a goal to educate about all these great companies that are up north that we don't see the headlines on every single day like you guys do.
Yeah, maybe I can start real quick on your comment on Go Residential, David. Back to my previous comment about Canada being 70-80% retail. That's the reason why they listed it here in Canada. In that's a theory of mine, a very humble opinion. I think that they had to do it before the elections, and I think that CIBC and the other big banks here did a very good job at distributing the product across the board. But they needed that distribution capability here up north, especially for the kind of size that they wanted to do. So kudos to go for doing that. I think that was an home run. But it's a bit sad to see that. Look, I mean, the biggest IPO ever on the Canadian market was for the US product. That's a bit unfortunate. That's fortunate and unfortunate, but we'd like to see a big IPO like this here in Canada at some point. Look, back to your question about maybe I can start with apartments. Very small universe, and keep in mind that here at Green Street, David, we only cover large caps because our clients pay for our research, and then they mostly care about liquid, institutional size names. And for now, we have a buy on Boardwalk. Now, keep in mind that Boardwalk is 70% exposed to Alberta and Saskatchewan, which is a more energy-driven area of the country and resource driven. And as I mentioned, I mean, fundamentals, at least for example, for a population and job growth perspective, are very favorable to Boardwalk at the moment. And from an alignment standpoint, what's interesting with Boardwalk is that it's 30% owned by 25% owned by Sam Colliers and the family. And so we feel like it's a good little alignment with the rest of the float, and we're short cap rate. So Ontario has been through some challenges, still going through some challenges at the moment from a job growth perspective, from a population growth perspective, and cap rate in particular has some specific issues. But we also feel like growth will be more exciting for Boardwalk when compared to a cap rate, at least for the coming 6 months. And we stay away from killing apartments from a valuation perspective. We also feel like so keep in mind, Killam is more like the eastern part of
Atlantic Canada.
Maritime. Sorry.
Yeah, the Maritimes, Atlantic Canada focused.
Eastern part of the country. And we don't see necessarily a big, exciting growth momentum over there. And so that's our positioning. Keep in mind also that across all the sectors, we need to be neutral. So that's mandatory, or at least try to be neutral across all subsectors. So that's our positioning for now. Though generally speaking, for apartments, as I mentioned earlier, I mean, on the negative side, there's lots of negatives at the moment, but we feel like Boardwalk is better positioned.
You cover 3 of the apartment REITs. How many other Canadian apartment REITs are there?
I'm thinking about at least one more. It would be Next Living, and is that the only one, Gaurav?
Oh, Minto just got acquired.
Yeah.
That was just been taken private. Intrent was taken private. BSR again listed on both markets. But yeah, again, these guys don't really make our sort of billion-dollar market cap cut, which is the reason why
Yeah, I'm
we're
just
not.
trying to figure out because you said we cover the biggest names, but
Yeah.
for some of those guys that maybe focus on the smaller mid-capish names,
Mhm.
actually there's three or four other names that they can look at. I'm not saying for you guys to speak on it,
Right.
but just
And
curious what else that universe looks like.
there's one name, other name exposed to the Canadian markets, and one name exposed to the U.S. market. Oh, two names, I guess, with Go Residential and BSR. And you got Next Living exposed to the Canadian markets, but that would be it. And when you look at
Okay.
Next Living, it's quite small. Like it's pretty small.
Call it a small cap. Yeah.
What about H&R? It's the only diversified REIT you guys cover.
Do we have to talk about it, David?
All right, let's punt on
No,
H&R. Let's
no.
talk
Look, I
industrials.
mean, look, I'm kidding here. Where should I start?
It's been in the
Oh,
news a lot. With
Okay.
I think let's just start with
Yes,
that.
we have seen those
so
headlines. But
it was
for
it
those
was a
that don't know, maybe share what's going on there.
Yeah, of course.
sure. It's look, I mean, H&R is a diversified REIT here in Canada. It's been in existence for a while actually, and it did diversify away from office and retail, and it started developing and buying apartment assets in the U.S. and they own a cross-border retail portfolio as well, and their industrial portfolio is also cross-border. And what happened is it was subject of a few activists, and these basically, if I can summarize real quick, there's been a bit of drama last year because those activists became a bit impatient, and all this created sort of a situation where management had to go out and PR about a few things, notably that they were doing a strategic review. And that strategic review. So keep in mind also that the Offsetter family, they own about 8% of that REIT, and that came to a conclusion where the strategic review didn't generate any results per se. So we're in status quo situation here, but the REIT sold a significant chunk of their portfolio, which we would call non-core portfolio. And where does that leave us with H&R today? Is that they will most likely, in my opinion, I think they will go ahead. They mentioned that on the call too, but I think they will go ahead with that plan. Is to split in two REITs. So we're going to have one residential focus, U.S. residential focus REIT, and you will have a most likely a cross-border industrial REIT just as well. Maybe there will be some residual assets in there, but that's where it's heading now. How to kind of positioning ourselves versus that REIT. That's why we have a whole rating on them, because it's a bit too uncertain of a situation to have conviction on that name at the moment, because you never know which way management will head. But to their credit, they were able to execute on large dispositions, and that's going to help the balance sheet. Of course, they might be buying back a bit some units, and that will also facilitate the process of clarifying and simplifying the situation with two separate listed REITs.
I mean, looking at it from the state's perspective, the simpler the message, the cleaner the story, the easier it is to
Mhm.
sell it to the investment community. Diversified seemed to do well many, many years ago. Now I feel like it has a negative connotation to it.
Yeah, absolutely.
All right, let's look at the industrial names, Dream and Granite.
I can take that up. I mean, two very large names here in Canada. There are two more on a smaller scale. One would be Nexus Industrial, and these other would be ProREIT. But the two that we covered, Dream Industrial and Grand. So right off the bat, one of these is externally managed, which is Dream Industrial, and I'll talk about that first. I mean, this is part of the broader Dream Group. They have basically built this REIT out quite a bit. They even they even acquired Summit, which was another industrial REIT, with GIC, and converted that into a JV. So this REIT owns and operates industrial assets, mostly in Canada, and then they have presence in Europe as well. So it's about 60% Canadian, 40% European. They also have multiple JVs through which they generate asset management fees. And yeah, the focus for these guys are the major markets here in Canada, namely Toronto, Montreal, and then even out west. Granite, on the other hand, we'd like to say about 50% the US, at about 30% Europe, and then about 20% exposure to industrial here in Canada. And it's a very strong internally managed REIT. It's got a strong management team. Both management teams actually are quite excellent. They're both focused on consistent cash flow growth. Though we'd say that Granite is a bit more cautious when it comes to capital allocation, and especially net external growth. Now, I'd say from our positioning, Granite has been on a tear, at least over the last six-ish months. Our ratings, sort of aligned with that as well. But these are the two large players, and naturally, one of the questions that we often get is, especially from global fund managers, is if I just want Canadian exposure, which one's the way to go? And if the larger Canadian exposure lies with Dream Industrial, better balance sheet with Granite at this stage. So we understand it's not an easy job for most fund managers out there, but these are the two more liquid names in the sector. And then again, two smaller names, Nexus Industrial and ProREIT. Pro more focused on Atlantic Canada, Nexus Industrial more London, and then a little bit of Alberta now, and BC. So that's basically the playing field as far as industrial is concerned. And it's also one sector which has been in the headlines a lot, given that we are in a tariff negotiation or renegotiation, however you want to call it. And the underlying dynamics here in Canada are, we'd like to say, perhaps a bit stable for the moment, but there is no net new incremental demand that's being generated across the sector.
I want to be very careful how I phrase this. Externally advised REITs in the States have a very bad reputation. You stated yourself that Dream has a great management team, even though it's externally advised. Did I hear that correctly?
Yes, I mean, they're very strong operators. They do know what they're doing. The structure, however, is something which will always penalize the REIT, especially when global investors are looking at it. And as you said, David, with that mindset, this will always be in the process.
I want to make sure I heard that correctly. All right. I'm looking at the list here. The next one up was Allied Office REIT.
Mhm.
83% leverage. Am I looking at that correct? Are they in that much debt?
Keep in mind that Green Street has its own comprehensive leverage methodology, and yes, you read that correctly, and that's also a
Wow.
function like, of course, the value of assets that was a bit impacted over the last few years. But yes, you saw that correctly.
Wow. I mean, that's a staggering amount when you look
Yep.
at REIT leverage numbers. That's a big, big number.
Yes.
Obviously, highest FFO yield of any of the companies on this chart as well. But like, what's this company's story?
So Allied as I would say class B, C plus, B minus, C plus portfolio across the country, but mostly concentrated in the western part of downtown Toronto and elsewhere in the country, like in Calgary and Vancouver, and Montreal, of course, their second biggest market. And yeah, I mean they got hit very hard by the pandemic, of course, and they at some point they represented maybe 75%, 80% of new supply coming to the Toronto market, and of course that new supply didn't help them right after the pandemic, and conditions have not improved Of course, on the positive side, trophy Class A segments, they did turn a corner. I want to say maybe 1.5, 2 years ago. But for the B plus segment, which is a segment that we cover on the private side here at Green Street, haven't seen any meaningful spillover from that turnover from the Class A trophy asset segment. And so because of that, like notwithstanding that back to the office movement that we're seeing right now and makes the news, that doesn't create new demand per se. The capacity was already there, and that's a nice to add. That's a positive, but we haven't seen anything meaningful in terms of the BB plus segment at the moment, and for Allied in particular. So just as you mentioned, for us, it's a matter of the balance sheet, and the REIT is exposed to quite a bit of risk in terms of debt maturities in the short term, in the very short term. And that's why we're on the sidelines, because from a, how should I put this? From the consensus NAV standpoint, and even from the published IFRS NAV, the unit is trading at a massive discount, right? But from our perspective, it's trading obviously at a premium, and so you got to be mindful of that equilibrium. But at the end of the day, I would say that we're relatively cautious on Allied at the moment, still today, and we'll see down the road, how it goes.
And if I can just
Right.
add two things here very quickly, David. One, Allied, again, this is not always the case. This is a REIT which owns office properties on the periphery of the downtown core. And most of these offices are they've been converted from light industrial buildings to brick and beam office. So, nice open area spaces, something which would have attracted a lot of tech tenants as well. The REIT also owns I'd like to say close to about 570 apartment suites here in Calgary and Toronto. And they do have a bit of condo exposure as well. I'd say the biggest challenge with the REIT has been that, as they started to grow and they really sort of hit the gas on capital allocation, but it was basically they were net acquisitive for a very long time. They had data centers as well at one point, which they disposed. But overall, between capital allocation, balance sheet management, there's been it was pretty heavy. And then once the fundamentals in the sector turned, there's just no place to hide at this stage. And that's probably what's resulted in, that comp leverage, which is our metric, but that has resulted in that leverage level shooting up. The fact that occupancy levels and just top line growth has been meandering lower is something which is affecting the REIT and its unit performance. At one point, this was at 50 bucks a share, and now it's closer to 14. But bear in mind that this is also a REIT which has gone through the pandemic when demand for office really did collapse. And it's taken a lot longer here in Canada for that demand to sort of stabilize compared to either East Coast US office or West Coast office for that matter.
Wow. That'll be an interesting story to watch. I'm going to definitely put that on my watch list. Thank you for that.
Absolutely.
Half your universe is retail, if I'm looking at this correctly. I didn't realize there were so many retail REITs up north these days. Are any of these companies like any of our REITs, let's say like Kimco, that are spread out coast to coast, that are in all 5 provinces and all the towns? Like, are any of these retail guys, do they qualify like that?
Yeah, I'd say so. I'd say almost all of them would fit that ticket in terms of geographic exposure. I mean, the bigger difference here is three of the REITs, that Choice Properties, Crombie, and CT, have a major tenant, which is a grocery store. So the largest grocers here in Canada are Loblaws, Sobeys, and then CT is Canadian Tire, which is not where we all shop for our tires, but they do sell them. It's basically, let's just say, it's if you ever need to get anything fixed in your house, you want to go somewhere and you got to pick up a light bulb, gardening tools, outdoor stuff. This is what it is. There's just no grocery aspect to CT or Canadian Tire. But these three entities are essentially major tenants. They comprise more than 85% of the REIT's revenue. And
Can I
choice.
pause you real quick? Can I
Yeah.
pause real quick? So are you saying that Choice, Crombie, and CT would be like grocery anchor shopping centers? Is that with the exception
Yes.
of CT, as you mentioned, but those would be considered grocery anchored shopping centers?
Yeah, we would say
Okay.
primarily just that, just because single tenant grocery, like Choice also has industrial and mixed use assets. So there's a bit of that as well. But the anchor there is Loblaws for Choice, which is a national grocery retailer. Same thing with Crombie. Sobeys is the major anchor there. They also have in the past wanted to develop apartments. They did that for a bit and then decided to dispose it as the market turned. CT is just Canadian Tires all around Canada, and again, they have pan-Canadian exposure. If you go down the order, First Capital is basically grocery anchored strips in urban areas, a very high quality portfolio. Primaris is our only mall REIT in the country. We don't really cover malls on the private market. Primaris is our only mall REIT. This was interestingly spun out of H&R, which we just discussed a few minutes ago. And that's
Watch.
fairly new. Pardon me. Go ahead, Fred.
No, I was about to say H&R bought it and then they floated after.
Yes. Yes. And
And then they
then
got RioCan and Smart Centers.
Yeah, Ryokan, it's been there for a very long time. They also own very core portfolios of retail across the country, which do very well. They do have some residential exposure as well, and that they're trying to sort through and figure out which way where it makes more sense to allocate capital to. Smart centers is basically that's basically a conglomerate retail REIT. They have strips. They're basically a Walmart anchored shopping center, but they have a huge land bank. They have a huge development pipeline. They have residential in there. They have self-storage in there. There used to be a little bit of office, which they have sold out of, but they like to play in, I'd like to say, in almost every asset class. And like I said earlier, land is a huge component of what they have on their books. So we could almost say that they're all very similar, but they're really not. You have to go through each of them with a fine-tooth comb.
Yeah, because it sounds like hearing you talk about a couple of these guys that they're not necessarily just retail, they are diversified, but yet you guys have them bucketed as retail.
Yes, in terms of major exposure, absolutely. Right. They are more retail than they are diversified. Someone like
Can
an
we talk about
H&R,
can we
which
talk about chart can we talk about Chartwell before I let you guys go, just because
absolutely.
Hazelview was so positive on it. I know we talked about senior housing demographics and outlook up north, but is Chartwell's the only company that fits that market cap requirement for you guys, I'm guessing? I see there's a hole. Maybe tell us the story there in your view.
So on Chartwell, look, I mean, I think it's a fantastic REIT. So it's exposed to very strong fundamentals. I don't think I have to expand more on that. But structurally, they did exceptionally well during the pandemic, and they have an exceptional team. For us, it's more a matter of the valuation at this stage with almost a 40% premium to NEV. But nevertheless, I mean, they're exposed to very, very strong fundamentals here. And what also we like is they have an exceptional access to capital, and they are also conservatively using it. So we like the discipline there on the capital front. They could improve the balance sheet a little bit faster, in our opinion, but nevertheless, they're in very good shape on that front. The other thing that we like, David, if I may add here, is that they won't take direct development risk. So what they do is they do partnership with local developers, and then that creates a conduit for the stabilized product to increase the size of their portfolio. And they do that here in Quebec, in province of Quebec, with Batimo, and they started doing that out west in British Columbia. And so overall, like a very well run operations, and but it's just a matter of valuation for us. We just cannot get there.
There's anything we've learned in the past hours that Canada is definitely more than Boardwalk and RioCan these days. That landscape has evolved dramatically. Fred, I want to work with you going back to our history to launch Sugar Shack REITs. We're gonna acquire up all the maple syrup farms and start doing Sugar Shack REIT. But in all seriousness, it's so cool to see how the landscape is evolving. I'm hopeful that when we chat a year from now, that a lot of these sectors have frankly turned towards the better, where there is a little bit more confidence on a sector by sector basis for what's going on, and not big macro political headlines that are kind of hindering its forward progress. But on behalf of the entire audience, I can't thank you enough for spending an hour with us and sharing Green Street's thoughts on Canada REITs today.
Thank you so much for having us, David.
Thank you, David. This was fantastic.